Mortgage lenders often spend $10,000 to produce a single home loan. On a $400,000 mortgage, the fees collected at closing typically come to about $5,000. So a lender can be in the red on your loan the day you get the keys, and profitable on that same loan a few weeks later without collecting a dollar of your interest. That is the first thing most people have backwards. This is not a business built on interest. It is built on margin, and the margin is thin. Add up every dollar of income on one loan, subtract every dollar of cost, and what is left is what the industry calls net production income. Across the industry, it has typically run from a few hundred to a few $1,000s per loan. On a $400,000 mortgage, that is a margin of well under 1%. A supermarket keeps a wider margin on your groceries than a lender typically keeps on your house. And in weak quarters, that margin can go negative. So if the interest is not the prize, and the margin is that thin, why does anyone originate a mortgage at all? Because one loan does not earn once. Depending on how the lender is structured, it can earn in 4 separate ways. And the first one is the smallest. Everything from here follows one simplified example. The figures are typical, not universal, and they vary by lender, by market, and by week. Our borrower buys a $500,000 house. She puts $100,000 down, 20%, so her loan-to-value ratio is 80%. She borrows the remaining $400,000 on a 30-year fixed-rate mortgage at 6.5%. Principal and interest come to about $2,528 a month. Over 30 years, that is roughly $910,000 in total payments, and more than $510,000 of it is interest. Written down like that, the business looks obvious. Lend $400,000, collect $910,000, wait 30 years. Except in most cases, almost none of that $510,000 reaches the company whose name is on her paperwork. And part of what she pays every month was never income to anyone. Her real bill is closer to $3,200. The difference is property taxes and homeowner's insurance, collected into an escrow impound account. That money behaves like a deposit a landlord holds for you, collected, held briefly, then paid straight out to her county tax office and her insurance carrier. So roughly a fifth of that monthly payment is not revenue at all. It is a pass-through. The lender's first real revenue arrives before she has made a single payment. At the closing table, the first way a mortgage earns is origination, and it is charged the day the loan closes. This is the only payday the borrower ever sees itemized, which is why most people assume it is the business. On a typical loan estimate, you might see an origination charge of around 1%. On $400,000, roughly $4,000. Add underwriting and processing fees, and the lender's share of closing costs generally lands between $4,000 and $6,000, depending on the lender. Call it $5,000. And not every fee on that closing disclosure belongs to the lender. The appraisal, often $500 to $800, goes to a licensed appraiser. Title insurance goes to the title company. Recording fees go to the county. Now set that $5,000 against what it costs to produce the loan. Industry surveys put the fully loaded cost, meaning loan officer compensation, underwriting, compliance, technology and marketing, in the range of $10,000 to $12,000 per loan, which means origination is generally not a profit center. It functions as a customer acquisition cost, closer to what an airline spends filling a seat than to what it earns flying you there. So if making the loan can cost more than it collects, why make it? Because in most cases, the lender was never planning to keep it. The second way a mortgage earns is called gain on sale. Most American lenders are not lending you their own money the way people picture it. An independent mortgage bank holds no deposits at all. It funds your loan on a warehouse line of credit, short-term borrowing that has to be repaid within weeks. So the loan is sold into the secondary mortgage market, one of the largest financial markets on earth. And here is the part most people outside the industry have never come across. Depending on market conditions, the loan can sell for more than the amount that was borrowed. If the note rate is attractive to investors, the loan might price at 102. On $400,000, that is $408,000. An $8,000 gain on an asset the lender held for about 3 weeks. That is not guaranteed. When rates move the other way, the same loan can price below par, and the lender absorbs the difference as a loss. Pricing is set by the bond market that week, not by the lender. So the lender is closer to a home builder than a landlord. It builds the asset, sells it at completion, and starts the next one. Watch the arithmetic move. Production cost, $10,000. Closing fees, $5,000. The sale, $8,000. The loan is profitable, the warehouse line is clear, and the same capital funds the next borrower. Turn that capital a dozen times a year, and a sub 1% margin becomes a real business, which means the entire model depends on somebody standing on the other side of that trade. So who is buying? This is the moment your mortgage stops being a loan and becomes a security. On its own, one mortgage is a difficult investment to hold. One borrower can lose a job, one roof can fail. Very few pension funds want a single loan on a single house, so the loans get pooled. 10,000 mortgages averaging $400,000 form a pool worth $4 billion. Slices of that pool are sold to investors as a mortgage-backed security, and the payments pass upward every month to whoever holds the slices. In the middle sit the government-sponsored enterprises, Fannie Mae, Freddie Mac, and Ginnie Mae. They set the standards a loan must meet to be agency-conforming, and guarantee payment to investors in exchange for a guarantee fee, historically a small fraction of 1% a year. That guarantee turns 10,000 separate credit decisions into a bond. A pension fund 2,000 miles away can own a slice without ever seeing a house. And this is where it reaches into your life. The 30-year fixed-rate mortgage exists at scale largely because of this machine. Almost no bank would hold 30 years of interest rate risk on its own balance sheet at that volume. Global capital will, because the risk has been standardized, pooled, and guaranteed. So your loan being sold is not something happening to you. It is the mechanism that made a 30-year fixed rate available to you in the first place. But some institutions do hold mortgages, and they earn from them in a completely different way. The third way a mortgage earns is the spread. Bankers call it net interest margin. A bank funds mortgages partly with customer deposits, and deposits are the cheapest money in finance. Pay depositors 0.5% while holding a mortgage earning 6.5%, and the gross gap is 6 percentage points. After funding costs, capital, and overhead, a realistic net spread might be around 2%. On $400,000, that is roughly $8,000 of interest income a year. Hold $10,000, and it is $80 million. Here the bank really is the landlord. It buys the asset, holds it, and collects the yield. But spread cuts in both directions, and so does time. A lender that locks a borrower's rate today and delivers that loan 6 weeks from now carries the market risk for every one of those weeks. If rates rise in the meantime, the loan is worth less to investors, and that $8,000 gain can shrink, disappear, or invert into a loss. That exposure is called the pipeline, and lenders hedge it, usually by selling forward in the TBA market against loans that have not closed yet. Hedging is a genuine cost of doing business, and when it goes against them, the quarterly results show it. So this is not a business that simply collects interest. It manages timing. And there is one more revenue stream that barely depends on timing at all. The fourth way a mortgage earns is servicing. Her loan has been sold. Investors own the cash flows. So who is she writing the check to every month? Somebody still has to collect that $3,200. Split it into principal, interest, taxes, and insurance. Pay her property tax bill twice a year. Run the escrow analysis. Answer the phone if she falls behind. That is the mortgage servicer, and it typically earns a servicing fee strip of about 25 basis points a year, 0.25% of the balance. On $400,000, roughly $1,000 a year, for as long as the loan stays on the books. On one loan that is a small number. Across a portfolio, it behaves like a subscription business. A servicer running $200 billion at 25 basis points collects in the range of $500 million a year. On loans, it may not even own. And the right to do that work is itself an asset. It is called a mortgage servicing right, an MSR, and it can be valued, bought, sold, and carried on a balance sheet, often worth around 1% of the balance. About $4,000 on our example loan. So one mortgage has now supported fees at closing, a gain on the sale, a recurring fee that runs for years, and a capitalized asset. 4 different companies, each paid for a different job on the same loan, which sounds like a machine that cannot lose. It has one flaw, and it is the most counterintuitive thing in this entire industry. Prepayment. That $4,000 servicing asset is only worth $4,000 because of an assumption that the loan stays outstanding. Servicers model it with prepayment speeds, an estimate of how fast borrowers refinance or move. If rates fall and our borrower refinances after 4 years, the loan ends early. Investors stop receiving the payments. The servicer stops earning the $1,000 a year, and the $4,000 asset gets written down. Bond investors have a name for this shape: negative convexity. Falling rates normally make a fixed income asset more valuable. Here, they reduce it. Nothing failed, nobody defaulted. The customer simply got a better deal, which is exactly what refinancing is for. A servicing portfolio is one of the only assets in finance that becomes less valuable when the customer's situation improves. The other side of the ledger is credit. If a borrower stops paying, the servicer often keeps advancing principal and interest to investors out of its own pocket while the loan works through delinquency. Foreclosure is slow and expensive, and the total loss commonly runs into the tens of thousands of dollars. Lenders also carry representation and warranty obligations. If a file was not underwritten to the buyer's guidelines, they can be required to repurchase the loan, all $400,000 of it, sometimes years later. Which is why the phrase mortgage company is doing a lot of work. It describes at least 3 completely different businesses. A bank takes deposits, funds mortgages with them, holds some loans on its own balance sheet, sells others, and earns both interest income and fee income. An independent mortgage bank takes no deposits at all. It borrows short-term, sells nearly everything within weeks, lives on origination revenue and gain on sale, and usually keeps the servicing rights. A mortgage servicer may originate nothing whatsoever. It buys or is assigned the right to collect, then runs the operation. 3 separate companies can touch the same $400,000 loan, and each one is paid for a completely different function. Which is also why the name on your statement can change, while your rate, your balance, and your terms stay exactly the same. So trace the whole path once more. She is approved and receives $400,000, funded on a warehouse credit line. At closing, the lender books roughly $5,000. Within weeks, the loan sells into the secondary market for around $408,000. It is pooled with thousands of others into a mortgage-backed security, guaranteed by an agency, and sold in slices to investors around the world. A servicer collects her $3,200 every month, keeps about $1,000 a year, and passes the rest along to investors, the county, and the insurance company. And she pays down her balance for years, while at least 4 companies each perform a different part of the work behind that single loan. So how much does a lender actually make on a loan like this? There is no fixed number, and any single figure would be misleading. It depends on loan size, note rate, what investors will pay that week, funding costs, hedge results, servicing value, credit losses, and overhead. Added up on our simplified example, and a lender might net a few $1,000s. Set that against the $510,000 of interest our borrower will pay over 30 years. Those 2 numbers were never in the same business. Her interest is spread across investors, guarantors, and servicers over 3 decades, most of it flowing to the people who put up the capital. And the industry is sharply cyclical. When rates fell and refinance volume surged, profit per loan reached unusually high levels. When rates rose and volume collapsed, many lenders reported losing money on every loan they originated, for several quarters running. That is the real shape of it, not easy money. Volume, timing, and the ability to earn from the same loan in more than one way. So the next time you make a mortgage payment, picture the path it takes. Part becomes a servicing fee. Part flows into a pool held by investors. Part is set aside for your county and your insurer. And the company whose logo sits at the top of your statement may have earned its return on that loan years ago. None of that is concealed. It is disclosed at closing, filed with regulators, and reported every quarter. It is simply infrastructure, and infrastructure is easy to miss when it is working. Your mortgage was never just a loan. It is a manufactured financial asset. Created, priced, sold, pooled, guaranteed, and serviced, sometimes several times over, while you pay on the first of the month. And that machinery is the reason a 30-year fixed rate exists for an ordinary buyer at all. Most people will use it their entire lives without ever seeing it. Once you can see it in mortgages, you start seeing it everywhere. Insurance, credit cards, auto loans. Almost every large financial product is built, priced, and handled by more than one company, each paid for a different job. If that is the kind of thing you want to understand, subscribe to Industry Hidden Truth, where we take apart how the world's biggest industries actually work.